the voice command. Okay. Are you recording?
Yes, we are.
Okay, great. Hello, everyone. This is Kathy Lien with BK Forex. I'm delighted to be here this morning to talk to you about trading the Asia session. All of you live in Asia, so I'm sure that it would be very, very valuable for you to learn some tricks and tactics for trading your session particularly. Now, what's interesting about the Asian trading session is that a lot of people end up avoiding trading the Asian session because they feel like it's a quieter time to trade. They feel like nothing really happens until Europe ends, sometimes until the US comes online. But that's not necessarily true. I feel that, there's plenty of opportunities in the European trading session that's oftentimes, in the Asian trading session that oftentimes is ignored. And the Asian trading session is actually one of the most ideal trading sessions to lay on some bigger idea trades, some swing trades. And so it's long been one of our favorite sessions to trade to either implement bigger theme trades or to even day trade. And the Asian session presents itself with a lot of opportunities depending upon what part of the Asian session that you're trading. So I'm very excited to share some of those ideas with you today, because regardless of whether you're joining me because you live in Asia, or, it also works if you live in Europe or North America, because oftentimes, at least the Asian Open coincides with, a reasonable time in North America. There is ways to take advantage of the Asian trading session. So I'd like to begin with showing you this disclaimer that says trading Forex carries a high level of risk and may not be suitable for all investors. So for those of you that are watching this video on demand, I highly encourage you to pause this screen, read through the disclaimer thoroughly before moving forward. So there are 3 golden rules to trading the Asia session. And this kind of lays the foundation of the way I think we need to think about trading the Asia session. And basically, those rules are knowing when to trade, what to trade, and how to trade it. That's the foundation of not only trading the Asia session, but obviously trading in general. So in this session, I hope to provide you with enough information for you to have a good feel of when to trade, what to trade, and how to trade. Now, it may seem easy, but there are different ways to approach this. So the first question that we're going to address is when to trade. So and this is probably the simplest, I think. Let's talk about who trades during the Asia session. Well, there's a variety of people who trade during the Asia session, depending upon the time frame of the Asia session that we are looking at. First and foremost, you have U.S. traders keying off U.S. market closes. And that's basically people who are watching, for example, the complete reversal that we had in U.S. stocks yesterday, where we opened down 500 points. We ended up 200 points in the Dow. And so that gave, that reversal gave U.S. traders the opportunity to lay on trades going into Asia and Europe. We also have end-of-day traders who are squaring their positions, looking at different opportunities at the end of the day, and basically looking to either take profits on their positions or put on stops and things like that. There are also obviously traders in Asia who are waking up to what happened in North America, and they're trading off of that, or they're trading for whatever reason during the Asian session. There's a ton of data that comes out from Australia, New Zealand, China, Japan, as well as Europe during the Asian session. So, you've got traders who are leveraging off of those releases. And of course, London Open traders. All of those are various market participants who come in during different times of the day to take advantage of those moves during the day. When it comes to the Asian trading session, timing is truly everything. It's important to realize that different times of the Asian session provide us with different opportunities. But timing does not just pertain to the time of the day. Time of the week can also be very valuable information because different times of the week also present themselves with different opportunities. This is just kind of a snapshot of the average daily range you can expect in some of the major currency pairs during the time of the week. And you can see that usually volatility or trading ranges are the greatest for some of the major currency pairs on Tuesday, Wednesday, Thursday, and to some degree Friday as well. But on Sunday, Monday, trading ranges tend to be much narrower. And we also have this experience in our own trading in the sense that when we trade, we tend to have the greatest follow through on Tuesday, Wednesday, Thursday, and we tend to have more minimal trading or narrow trading or more reversals on Monday. Friday is hit or miss depending upon whether we have key US data, depending upon whether there's motivation for profit taking. So there are other things going on during that time of the day, but in a nutshell, the day of the week is also just as important as the time of the day. But in terms of the time of the day, I know this is a little hard to read, but all I want you to really look at is the peaks and valleys. Like, for example, it should be no surprise to you that the greatest average hourly moves in the euro dollar are pretty much right before or leading up to the London close. And some of you may still be awake during that time and available to trade. Some of you, obviously may not be, but that's when we have the greatest trading ranges. But that's not the only time, because if you look at the euro dollar, the towards the left of the green space is right around the London Open. And so you usually get a spike in volatility or trading ranges at the London Open, at the London close, and the quietest time of day, giving you opportunity to lay on swing trades, is kind of the edge of the blue area around when the U.S. stock market closes at 4 p.m. and a little bit thereafter. So how can you use this information to your advantage? Well, I think there's a couple of different ways to look at this. First and foremost, I think that the most important way to look at this is to basically say to yourself that if I want to look for potential breakouts, and I've got an isolated amount of time to look for these breakouts, then depending upon what time of the day I'm up, then perhaps the London Open, which is generally a reasonable time for most people in Australia, certainly most people in Singapore, depending upon where you're dialing in from. That's the opportunity. That's where I think you have the best opportunity for a potential breakout move. Now, if you're someone who is basically staying up later in the day or later in the morning, then perhaps one of your best opportunities is when you have the London close, because that's also when you can have the possibility of some interesting opportunities near the London close. So that's also something I think worth watching as well, because that presents itself with different types of opportunities. This kind of gives you in numerical terms the kind of trading ranges that you can expect during the course of the day. And so, the Tokyo session is obviously the quietest session. So generally, fade trades are more fruitful than follow trades because they tend to have more opportunity and maybe even more possibility of reversals. But when you get into the London session or the London hours, that's when you may have the greatest possibility of continuation. And so you probably don't want to be looking at fade trades during that time. So we talked a little bit about the times of the day, the different opportunities that you have for bigger ranges, narrower ranges. But I think it's important to look at how we can approach this from a trading perspective. And when we look at it from a trading perspective, I think that we've got to look at the market in two parts, which is that the greatest opportunities, in my opinion, is A, when we have the market open, which is either the Asia Open, the London Open, or the New York Open, depending upon what time of day you're up. And when you have the Asia-Europe overlap, that's when I think you have the greatest opportunities for some decent liquidity. So which market opens first? Obviously New Zealand opens first, followed by Sydney, Tokyo, Hong Kong, and then Singapore. So New Zealand data tends to be the first set of economic releases that come out. And in terms of the economic releases that come out, New Zealand data comes out around 21 GMT. We also have Australian data, followed by Australian data, Japanese data, and Chinese data. I don't know why this slide deck kind of messed up the font, and I apologize for that. But taking a look at some of these other numbers, what you can also see is that the most important releases during those sessions, let me see if I can just edit this real quick so you can actually see that, what I'm writing there. There you go. So the most important releases during those sessions are basically the rate decisions. Those are obviously very, very important. The rate decisions are always, very impactful for the currency. The BOJ, RBA, RBNZ rate decisions are, very, very important. We also have the Australian employment report that's very tradable. We also have the New Zealand employment report and inflation, which is also quite tradable, along with Chinese GDP, Australian retail sales, inflation, and PMIs. These are pretty much the only, quote unquote, only pieces of data that we really trade during the Asian session, because they tend to be the only, quote unquote, only ones for serious opportunity. The other ones I don't think really elicit too much movement, and so really don't give us much in terms of potential moves in the currency. So I don't think we get too much out of those. But these are the releases that are very, very much tradable. So understanding, when's data is released, which markets opened first, and what are the most important releases. The next question to ask ourselves is obviously, what are the catalysts for Asia moves? And the catalysts for Asia moves are basically the following. It's going to be Asian data, the ones that we just talked about, central banks speak, stop hunting, and any political headlines. I mean, yesterday was the classic example where we had that big major news bomb from China, where they came out and they said, they're gonna do $50 billion worth of U.S. tariffs. And these days you can get not only news bombs from China, but there's also quite a bit of possibility for news bombs from President Trump as well. If he's up later in the evening, especially after the U.S. markets close, if he's up, he may be in the markets basically tweeting, and that could affect how currencies trade. Now, it used to be that we used to have headlines from North Korea as well, but I think that's far less of a risk these days than it was before. But at one point, those are the type of political headlines that can have a potentially dramatic impact on the currency. So we looked at when to trade. The next question that we want to ask ourselves is what to trade. And I promise you, how to trade is obviously the most interesting part of everything. Um, but what to trade is also very, very important to understand. So starting off with what to trade. In terms of what to trade, during the Asian trading session, it shouldn't surprise you that dollar yen, the yen crosses, the Australian dollar and the New Zealand dollars tend to be the biggest movers because you've got Japanese data, you've got kind of follow-through movements from the North American close. You also have the Australian New Zealand dollar pairs. What are the worst currencies to trade? Well, the worst currencies to trade are basically, at least at the start of the Asian session, most of the European the European or Swiss pairs because these countries usually you don't get too much of the data around that time, and the numbers that you get aren't necessarily very fruitful. So as a result, you may not have too much opportunity there. So you may not get too much opportunity with the Swiss pairs, and you also may not get too much opportunity with dollar CAD because dollar CAD really doesn't move all that much during the Asian session. Dollar CAD really only kicks off when we have the North American session. So you really don't get too much movement there. So what can you trade what can you trade knowing that? Well, the different things or tactics that we can trade during the Asian session is that we can trade breakouts, we can trade data, and we can trade data and price fades. So that's basically what we're going to kind of detail for you today, and basically introduce different ideas for you to potentially take advantage of during the Asian session. And that leads us to the third golden rule, how to trade. So we talked about when to trade and how the Asia session is segmented in two parts, which is that there's opportunities in market open, there's opportunities with news releases, there's opportunities with market overlaps. And we're going to apply those ideas to our trading strategies in just a second. And then we talked about what to trade and which currencies move during those times and so forth. And that will also be applied to some of the ideas that we have in just a minute. But that's basically laying the foundation for understanding how to trade. When it comes to understanding how to trade, we all have different quote unquote priorities or things that we're looking at. And basically, they boil down to day trades and swing trades. There are both day trades and swing trading opportunities during the Asia session. In terms, and we'll start with day trading because that's where the greatest opportunities, I think, are. But swing trading obviously is, or I wouldn't say the greatest, that's where the most frequent opportunities are. Swing trades we see every so often, and I'll share with you some tactics to swing trade as well, but we'll start with day trades. So is day trading better? In the Asian trading session, particularly the first part of the Asian trading session, we have to agree that generally day trading is better because if you remember the average hourly ranges chart that I showed you earlier, which is basically this one. At the start of the Asian trading session, you tend to have much tighter and narrower ranges. And because you have much tighter and narrow ranges, what does that tell you? Especially in the 18 to 20 hour, which is when you tend to have Australian and New Zealand releases come out, that tells you that usually you'll have a spark in volatility on the back of those news releases, and then the news fades. So that's why when it comes to trading in Asia, day trading is better because you may not necessarily have the continuation that you may be hoping for in other sessions. In the Asian session, is it better to go trend or to follow the trend or fade the move? And undoubtedly, fade is the best way to go when it comes to trading in the prime Asia sessions, especially when it comes to data. And this comes from many, many years of experience, trading in the markets. And we firmly believe that when it comes to any of these releases, fading is better than following. And I want to show you exactly why. So let's take a look at this Australian retail sales report. So the Australian retail sales report, you can see, came out much stronger than expected. So it came out much stronger than expected, 1.2% versus 0.4% forecast. So you would say to yourself, wow, this completely blew out expectations. It's 3 times stronger than anticipated. So given that it's 3 times stronger than anticipated, Aussies should not only rise, but have quite a bit of continuation. But look at what happens. This is a 15-minute chart. And yes, of course, we had Aussie dollar pop higher at the onset of the release, which is the large green candle that you can see on this chart. But after that, look at what happens. After you see Aussie dollar pop up at the onset of the release, then it continues a little bit. So the peak of the move is 78.60. It gets not even to 78.70. So it continues maybe in the next, this is a 15-minute chart. So in the next 30 minutes, it only goes about another 15 to 18 pips. And you're sitting with this trade, you're thinking, wow, this number is so strong, I'm going to bet on continuation. You're sitting there thinking, why in the world is it not moving? And the reason why it's not moving is because this is a natural characteristic of Aussie dollar, or the trades that you get in post news in the Asia session, which is that you get this huge run up and then it doesn't continue and actually reverses. And in fact, the better trade in this case would be to fade the move, because it consolidates for about an hour and then ends up falling and pretty much gets to its pre-news levels. Let's take a look at another example. In this example, we had New Zealand's ANZ business confidence numbers. And you can see, and we also had GDP numbers. So GDP numbers were right in line with expectations. And we had an upward revision to the previous month, which is why you're seeing the green notation there. So we had an upward revision to the previous month. And we had, stronger New Zealand business confidence. So you would say to yourself, okay, so GDP was revised upwards the previous month. The current quarter was right in line with expectations. I should buy the Kiwi dollar. And lo and behold, what happens? Well, yes, initially we do have quite a bit of movement upwards in the Kiwi dollar. We have a move from 69.70 all the way to 70, almost to 70.20, which is about a 50-point move. But the bulk of that move happens in the first half hour. And then what happens after that? The peak of this is 70.20. Between the first half hour and the next 2 hours that follow, you only get another 8 pips of movement, maybe. Maybe not even that much. And you say, and you're holding this position thinking, those numbers were good. The initial reaction was strong. why in the world is this not continuing? And there's nothing more frustrating than that, in my opinion. And so you're in this situation, you're watching the trade, and you're thinking, you're kind of hitting yourself in the head, thinking, I shouldn't have jumped onto the news data. In the North American session, sometimes when you jump onto the news data, you have quite a bit of continuation and movement and opportunity, but that is oftentimes less so the case in the Asian trading session. So these examples and countless others tell you that fading is the trade is undoubtedly to fade. And the reason why fade is better than following the news release or following the breakout in the Asian trading session is because during the Asian trading session, the market is controlled by only 4 banks, ANZ, Commonwealth, NAB, Westpac. So there really isn't that much participation. And it just shows you kind of the share of the market that these 4 banks have. Whereas in the North American and the European trading sessions, you obviously have a lot more participation, and you have a lot more people in the markets, you have a lot more people interested in the markets, and you tend to have more continuation opportunities. But that's just not necessarily the case in Asia. And because the market is encompassed by mostly dealers, and retail traders like ourselves are usually more active during the European and US sessions, dealers tend to fade moves more than follow them, because dealers, if you think about it, are much more what we call mean reversion traders, which means that they tend to if they see a big breakout, they tend to fade those breakouts more than follow them. So dealer markets, breakouts, fading breakouts tend to be the best opportunities. Are there exceptions to the rules? Of course, there are always exceptions to the rules, and that depends on the intensity of the news. Because if you get something like a huge complete blowout surprise in the employment rate in Australia, which is very impactful, and oftentimes much more impactful than the than the retail sales report, or if you have a monetary policy announcement, you can have quite a bit of continuation. But there's still a caveat, and this is the caveat, which is that this is the Australian unemployment report. Obviously, the number was very, very strong, and it's and in this case, the number completely blew out expectations. And the caveat is that you still cannot expect immediate continuation. In many ways, it's a similar scenario as what we saw in the other examples, which is that you're in the trade and you really don't, and you buy it after this blowout number. In this case, you get a little bit of continuation. If you bought around 76, it goes up to 76.14. Okay, not too satisfying, but you get a little bit of movement, and you're still stuck in the trade for what looks like this is 6 up to like 1 o'clock, and you're still stuck in the trade for 7 hours before Europe comes in, sees that wonderful number, and starts to drive the currency pair higher. So that's the point that I'm trying to drive at, which is that the point that I'm trying to drive at is that when it comes to a lot of these news trades, your only choice is to fade the initial move, or to wait till Europe opens and then follow the continuation that you get after Europe opens. Because once again, in dealer markets, breakouts tend to be faded more than followed. So in review, when it comes to trading news, particularly in this Asian session, fading is the best, because it's a dealer market at the start of Asia. But strong surprises can cause continuation, but you can't necessarily expect that continuation until the European markets open. And that's when the outside capital flows come in, and you tend to have a bit more of a movement. And if the initial reaction is greater than 50 pips, that's when you want to either stand aside or wait till the European Open to follow the trade. Another unique opportunity during the Asian session is trading what we call the Sunday gap. This only happens in Asia. It's the only session we have this opportunity, and I think it's a good one. I mean, this is basically the main market that we have. This is the only market that we have that presents with us the Sunday gap, and this is actually a highly accurate strategy. And when it presents itself, it can be a very good opportunity. So, what is a gap? A gap is basically a jump in price when the markets reopen for trading on Sunday. In general, the FX market is continuous. You all know that our market trades 24 hours a day, but there's one exception. And that exception is basically over the weekends. Obviously Friday at the North American close, those markets close, and we don't open up again until Monday, your time in Asia. So sometimes when there's a big news over the weekend, or there was a big close on Friday, you may have a gap on Sunday, Monday that can be quite significant. And the most important thing about these gaps to know is that the vast majority of gaps are filled. As much, and we've seen this with small gaps, we've seen this with large gaps. It is very tempting, extremely tempting to see some of these gaps and then basically turn around and say, this was caused by some major Chinese announcements, therefore, there should be continuation, or it's driven by, North Korea threatening to, flexing the muscles with their nuclear tests. But lo and behold, again and again, the gaps tend to be filled regardless of how big they are. So fading the gap, just like we fade news, can be a very profitable strategy. Because as you saw in this chart here, even though we had a 162 pip gap, which is a huge gap, the gap was filled very quickly. And this is another fairly recent, this is another example where you see this gap, and it's not like it's a huge gap. I think it's like a 40 pip gap. And there's a little bit of continuation, but it's not a very long continuation before the gap is filled. Gaps are filled generally 80% of the time. Sometimes they can be filled quickly, sometimes they can take a little longer. But if you're inclined to trade Sunday gaps, you need to give yourself plenty of room, because there does tend to be a little bit of continuation at the onset, because people see the gap, they get excited for the reason for the gap, and they may take the pair a little bit higher. But if you give yourself about 100 pips with a 24-hour time stop, then in our experience, and of course past performance is not indicative of future results, 80% of the time the gaps tend to be filled. Now, if the gap is not filled within 24 hours, then it's what we call a runaway gap. In that case, you need to cover, because runaway gaps are some of the strongest signals ever. So basically, with gaps, you can give yourself a price stop as well as a time stop, and it needs to be filled within this time period in order for us to believe that whatever, in order for whatever news flow to have already been digested by the market. If it doesn't get filled within the first 24 hours, most of the time you still have the case you still have the opportunity to close the trade at a not at a huge loss because it hasn't really run away yet. But it certainly tells you that the market does think that the news is significant enough to maintain the gap. So those are basically the guidelines for trading gaps. So in review, gaps only occur in the Asia Open, and it's one of the unique opportunities that we do get in Asia. 80% of the time, gaps are filled, so fading them is a profitable strategy. But you do need a wide stop of about 100 pips, and you also need a time stop of about, I think usually 24 hours is good enough. But if you want to wait a little bit longer, maybe 48 hours, but 24 hours tends to be good enough. And if a gap is not filled, we have to assume that it's a runaway gap. And then at that point, you can probably trade in the direction of the runaway gap. So those are basically two ways to day trade during the Asia session. Now, the other way to trade is obviously to swing trade. And swing trading, the best time for, in swing trading, we find that the best times to lay on your swing trades also tends to be at the start of the Asian session. And so we can use Asia to our advantage to lay on these swing trades because the closes on our candles basically are right before or right at the Asian Open on the daily charts for the majority of charting packages. So by that time, we've known that whatever movements that we've had in the North American session, the European session in the last 24 hours is confirmed, and then we kind of ride the move that follows. So when it comes to swing trading, hands down, my favorite strategy has always been to use the double Bollinger Bands. And I use, and the double Bollinger Bands are basically two sets of Bollinger Bands. Whenever you lay Bollinger Bands in your charts, you'll always get the outside line, the 20 period 2 standard deviation Bollinger Bands. And what I like to do is add in the inside line, the 20 period 1 standard deviation Bollinger Bands. And these Bollinger Bands can help us pick tops and bottoms, and also can give us a variety of different information. At bare minimum, the way we look at this is that if the price is trading in the 1-2 band, the 2 upper bands, it's an uptrend. If it's trading the 2 lower bands, it's a downtrend. And if it drops out of those areas, that means that the trend has lost momentum. And that is the part that we're trading. We're using the double Bollinger Bands to help us pick tops and bottoms. So what you want to do is first, for a long trade, you want to look for the currency pair to trade between the 2 lower Bollinger Bands. So if you see the currency pair trading between the 2 lower Bollinger Bands, that's when you want to buy. And that's when you want to buy, when you see that it's trading between the 2 lower Bollinger Bands and closing above the first standard deviation Bollinger Band. And that's basically what you see here, where you see a dollar yen falling and trading in below the 2 first standard deviation Bollinger Bands. And then the green candle that I'm pointing at is when it closes above the first standard deviation Bollinger Band. And that's your first signal to buy. So this should say first signal to buy at 111.91. Your stop is 75 pips, because generally speaking, if it moves 75 pips against you, it's already dropped back below the first standard deviation Bollinger Band. And when I trade, I like to use multiple exits. So you want to close half of your position when it moves about 50 pips. And then when that happens, you want to move your stop to break even on the remainder of the position and trail it by 20 pips to see if you can capture a real turn rather than just a short-term turn. So here we're buying at 111.91, stop at 111.16, which is most certainly back below the first standard deviation Bollinger Band, which means that your turn is no longer a valid one. And you target 50 pips for the first move because you want to trade this defensively to get 50 pips. That's probably a decent sized move in the currency pair. So you target 50 pips for the first move. You exit 112.41, which happens pretty quickly, and then you trail your stop. In this case, you probably would have just exited at your first exit because you see the next candle's a red one. It does reverse quite a bit, but sometimes it can become a very nice uptrend. Like if you look at the left-hand side of the chart, some of the turns are much stronger. In that case, you can participate in more of the continuation. You can also use this strategy to pick tops and bottoms to the short side. So on the short side, what you want to do is you want to look for the currency pair to be trading in the two upper bands. So you want them to be trading in the buy zone. So they're trading in the buy zone. Then what you want to do is you want to look for the currency pair to drop out of the uptrend buy zone, which basically involves closing below the first standard deviation Bollinger Band. And of course, the longer the amount of time it spends in the upper of the Bollinger Bands, the more significant the turn if you catch it. But in this example here where my blue arrow is pointing, you'll see that the currency pair was moved into the 1-2 band on the upside. Then it rolls over and it closes below the first standard deviation Bollinger Band. And what's really nice about this is that your stop is of 75 pips is also very technically significant because it's right around the peak high. So that's when you see the signal set up. If it closes below the first standard deviation Bollinger Band, you can go ahead and short the candle, the next candle. So basically after the close, you can sell the move or the new candle the following day. So you can sell the new candle the following day, and you sell here 113.20, stop 75 pips, target 50 pips with a 20 pip trailing stop on the position. And this is how the trade would have looked, where you basically sold at 113.20, your stop's at 113.95, which actually is above the swing high. So you actually probably didn't even need such a wide stop. You could just probably put it at the swing high, 2 candles before that, which probably was around 113.70s. So you could have tightened your stop to maybe about 50 pips. And you target 50 pips. In this case, if you trailed your stop, you probably would have gotten more of the move because it did have much more continuation than the other example that we saw. So this is a great way because these candles close when Asia opens. So when you wake up, and usually you have, if you remember the graphic that I showed you earlier that says that between 4 to 7 New York time, there is generally not much movement. You have time. You have time if you wake up. You don't have to wake up at 4 New York time. If you wake up a little later, depending on what part of Asia you're in, you have time to get in because usually there isn't too much movement. So in that case, you wake up and you see the New York candles closed. You see the setup. It only takes 5 minutes a day to go through all of your major currency pairs, and you can lay on. Usually, a quote unquote lower risk swing trade, like you're not risking hundreds of pips, and basically put on, look at the daily charts to identify swing trading opportunities. And that's how you can use the Asia session to your advantage. In terms of identifying the best fundamentally driven trades, what that involves is a fusion of technicals and fundamentals. And what I like to do is, and even on a day trading basis, it's a fusion of technicals and fundamentals. But on a swing trading basis, if you saw the picking tops and bottoms setup, and it's driven by a fundamental development in the North American session, either a very significant U.S. market, stock market open or close, or maybe a really good or bad non-farm payrolls report, or big announcements by the Federal Reserve. That's the kind of highest probability, most attractive opportunity, where you've got the technical setup and you've got the story. So when it comes to identifying the best fundamentally driven trades, you want to first identify the story, the big story during the last 24 hours, or the big theme in the markets. Identify the currency most affected by the theme, and usually, it could be the euro, the pound, the US dollar, and then you look for the strongest, weakest close during the New York session. And you're looking for the strongest, weakest close during the New York session, anticipating the possibility of continuation in the days that follow. When it comes to news trading, you can also use fuse fundamentals to your advantage, in the sense that after I'm sharing with you this information, that dealer participation is less during the start of the Asia trading session, particularly when Australia and New Zealand releases come out. So knowing that's why the fade trade tends to be more effective than the follow trade until maybe the European Open. So with all of this in mind, how do you plan your trading day? Well, what you do is, first of all, the first thing you do is at the start of the Asia session. That's the best time to plan your swing trades, because the markets are quiet. You have the candle closes, and that's when you see the possibility of continuation. And then after you've planned your swing trades, then you can plan your day trades. You can look for follow through if the data is strong enough. You can look for breakouts at any start of the opens. You can fade news, you can trade data, or you can look for the fills of gaps if it's Sunday. So your trading plan would be, first step is you turn on your computer, you wake up, you catch up on overnight developments, look for continuation trades, and then you identify, swing trading opportunities. After you've done that and kind of set up your swing trades, you can wait for data releases or breakouts. And when you see the data releases, the quote unquote best opportunity is to fade the move, or look for mean reversion, or trade the ranges. And then you can leverage on any profit taking you had before the London close, if you're still up during those hours. So that's how I would take all this information and combine them together into a trading plan for on a day-to-day basis for the Asian session. So hopefully you found this session valuable. I thank you all for joining me, and I'd like to now open up the floor to any questions you may have.
Thank you, Kathy. Just got a few questions here. So going to the fading trades, I was asked, how do you pick the top or the bottom before committing to a fading trade after the initial move?
Well, generally speaking, if you don't get continuation within the following, 45 minutes after the news, usually it's more just consolidation, then you can assume that maybe if it's not like a huge data release, you can assume that that would be a good place to put your stop to fade the trade, maybe 10 pips above that.
Okay, great. And in terms of directly when the market opens in the Asian session, how long should you wait before or looking to enter a trade, because of spread widenings and stop hunting and things like that?
That's a very good question. So if you're on a regular day basis, not on a Sunday, the spreads only really widen, I would say, for about half an hour to 45 minutes. So in my time, basically the best time, between 5 to 6, you tend to have spread widening, more closer, I think, to, yeah, between 5 and 6. And then pretty much when you get closer to 6, the spreads have narrowed again, and you can lay your trades on that time. On Sunday, you have a little bit wider of a range, and I think, maybe by, 6:37, usually the market's kind of digested whatever big news they have, and the spreads have widened as a result, have narrowed as a result of that.
Great. And in terms of for your double Bollinger Band strategy, what time frame do you usually trade that on?
Daily charts. That's why it's a swing trade strategy.
Awesome. And one question, very concerned trader, is why do you have a uneven risk to reward strategy for your double Bollinger Band? So I think risking 75 pips to gain 50 pips.
That's a very good question, because you got to be realistic, which is that sometimes you may not have so much continuation. So when we trade, we always practice what we call high probability trading versus high profit trading. So it's not, you don't always have negative risk reward, because you still have your second half of your position, which you could potentially trail your stop and take advantage of the move. But the worst case scenario is like, you expected, let's say you picked the top and bottom, you expect a continuation, moves 50, 60, 70 pips in your favor. You don't, you're trying to go for this ideal risk reward of at least 1-to-1, which is 75 pips. And then, you see it go up 70 pips, and only for it to reverse and then completely go back to break even. I mean, there's nothing more frustrating than that. So we've always practiced what we call trading defensively, which means that, we, when we've got the profits, we like to bank them. And then we allow, the second half of the position to run if we do get a big move.
Great, thank you, Kathy. And that seems to be it for the larger questions. Just to answer everyone else's question, this will be recorded and sent out to you tomorrow. But yeah, that seems to be the major questions for now. Thanks, Kathy.
Okay, sounds good. Thank you so much for joining me today, and I hope you all found this session valuable.
Thank you. Have a great night, everyone.